Buying the S&P 500 index fund. So we know from a previous episode that Warren Buffett's best investment advice is to buy the index fund. And this is something that you want to dollar cost average over time. We talked about dollar cost averaging and what index funds are, the different kinds: Dow Jones, S&P 500, Nasdaq, and Russell. The benefits of the index, which is basically a diversification, and also looking into the annual report of Berkshire Hathaway and looking at specifically Buffett's specific words about investing and what it means for you. So he says to buy the S&P 500 index, but there are lots of different ways to do that. You can open an account directly with Vanguard and dollar cost average without paying trading commissions over a period of time, and that would be with Vanguard directly. Or you can just use any brokerage such as Interactive Brokers, TD Ameritrade, E-Trade, Fidelity, and buy either SPY or VOO. Now, VOO is relatively new. They began in 2010, and it's actually an S&P 500 tracked index fund that's created by Vanguard. So you can actually buy VOO from any brokerage account. Likewise, you can also buy SPY, which does exactly the same thing. And while there are some slight differences between SPY, VOO, and opening an account directly with Vanguard to buy their Admiral share or investor share classes of the S&P 500 index, they basically all do the same thing, which is track the S&P 500. So worry less about the differences in performance between these three and more about dollar cost averaging over time and not buying when it's super high and making sure that you are buying when there's a dip. So when you open an account with Vanguard.com directly, they have two major different share offerings within that fund. One is the investor share class, and the other one is the Admiral share class. Now, the difference is in expense ratio. Obviously, the Admiral share class has a better expense ratio of 0.05% versus 0.17% for the investor share class. So the investor share class is about 3 times more expensive, but there's a lower starting amount. So you could start investing with as little as $3,000. With the Admiral share class, you need more money. You need $10,000. So if you have $10,000 to invest, that's the ideal situation. That way you get the 0.05% expense ratio with that $10,000 minimum through the Admiral share class. But if you don't want to invest directly with Vanguard, and you don't have $10,000, how can you still get that 0.05% coveted expense ratio? Well, it turns out you can still do it. You could get that 0.05% expense ratio, and you do so by buying VOO. This is a ticker, a 3-letter ticker. Just like SPY, VOO tracks the S&P 500. They basically do the same thing, and you can buy VOO with any brokerage. Typically, so the only difference with VOO is you have to pay a brokerage trading commission. And so each time you try to dollar cost average, you want to buy some this month, buy some next month, you're going to have to pay a trading commission each time. Whereas if you open an account directly with Vanguard, they have all the shares, so all they need to do is just allocate it to you, so you won't be charged a regular trading commission fee. Now, you shouldn't really have to worry about trading commissions unless you plan to dollar cost average quite a bit. But if you really wanted to avoid that trading commission, there is a way to do that, and I'll show you how. But just a quick recap, the 3 major Vanguard offerings that you should know about are: number 1, VOO. This is the ETF that's created by Vanguard. It has the expense ratio of 0.05%, which is what you want. And you can access it without being tied to any single brokerage. There's also the investor share class. This is the one that requires a minimum of $3,000, but you get charged a little bit more, 0.17% instead of 0.05%. And for the Admiral share class, this is number 3, that requires a minimum of $10,000 and the expense ratio of 0.05%. My recommendation is to buy VOO. That's the best way to get the Vanguard S&P 500 exposure at 0.05%. You just have to pay trading commissions. Now, I talked about how you can avoid trading commissions. Yes, you actually can avoid it. And the way to do that is through a free trading brokerage account, such as one with Robinhood. Robinhood, the app, it's also available on Robinhood.com, lets you buy any stock, any 3-letter or 4-letter stock with $0 commissions. Of course, they make money in other ways. They sell you different kind of memberships, and if you want extra margin buying power, they charge you for that. But if you know what you want, if you just simply want to buy the index, then you can use Robinhood to buy the index. And if you want a dollar cost average in the way Warren Buffett recommends, you can do so by buying a set dollar amount over a period of time. And it won't charge you commissions over time. How do you get started? Well, first you have to download the app or go to Robinhood.com. Then you fund your account. Now you can kind of link your existing bank checking account into the app. It's really easy. I was able to do all these steps in less than 10 minutes. So if you have a bank account with Bank of America, Chase, all you need to do is just log in there with your credentials, and it'll link it to your Robinhood account. And then you transfer some amount of money. And all that money won't be available to trade right away. So maybe like 10 to 50% of it might be available. And that's the amount that you take to start investing right away. So within that 10-minute period I was talking about, you can take 10 to 15% of what you're transferring and immediately put that to work, assuming the markets are open. And so what you would do is type in SPY or VOO, either one, and then you type in however many shares you want to buy. So let's say something is trading at $200 and you have $1,000 to invest, then you would buy 5 shares. So you would buy 5 shares and put in your order, and there would be no fee. So that's how you get invested into the S&P 500 with Robinhood. So that's a little bit tricky though when it comes to dollar cost averaging. So buying it itself is very simple, but when you dollar cost average, you put $1,000 that first month, you bought 5 shares. Well, what if the SPY goes from $200 to $220? Well, in month number 2, if you want to buy $1,000 worth of S&P 500, you can't buy 4.8 shares or whatever it is, 4.9 shares, because you can't buy increments other than 1 in terms of shares. So this is what makes dollar cost averaging kind of difficult. And if you were to do it with Vanguard directly, it's easier because then they can allocate you decimal amounts of number of shares. And so that's one of the drawbacks with buying VOO or SPY. You have to buy a specific numeric integer number of shares. You cannot buy a decimal number of shares. Now, of course, if you have large amounts of money to invest into it, you can always just round up to the nearest share, and it's not going to make much of a difference. Each share is maybe $200, and so it's only a slight rounding error. But if you're investing smaller amounts, say just under, I'd say $2,000 or $3,000, then it does make a difference in terms of your effectiveness in dollar cost averaging. But if you're okay with just estimating, then I would say buying the SPY and VOO still is the preferred method. Now, some people say, oh, well, the stock market's really, really high. It's still too late. Actually, someone not too long ago in October was asking me about how they can invest their money into the stock market. And I recommended SPY. And they said, isn't it too late to buy now? And I said, oh, actually, based on my pattern analysis of where the market is, it's actually a good time to buy right now. And he's like, are you sure? So, not only did I recommend him to buy, I myself opened up a Robinhood account and funded it with $8,000. This is actually my trade history that I'm looking at. On October 27th, 2016, I put $8,000, and actually I probably put that money in October 20th, but it didn't settle until 1 week later. But I bought SPY on October 20, and then I bought, of that $8,000, I only had access to 1,000, so maybe 12.5% of that I was able to use immediately. So with that, I bought a little bit of SPY. I bought about $850 worth of SPY because I couldn't buy exactly $1,000. And then once my funds settled, then I immediately bought IWM, which is the Russell 2000, and QQQ, which is the NASDAQ. Now, after I bought the IWM, 2 days later, on October 29th, the IWM dropped. So actually, when it dropped, I bought more. And so that's kind of like the concept of dollar cost averaging. Of course, you could do it according to whatever time period you want, but based on the pattern, of this going into the election, I bought here and I recommended to my friend who was interested in investing, who was afraid to buy at these levels. I recommended to buy, and it turns out this was a pretty good time to enter, as this $8,000 actually just 1 month later is now worth $8,637. So that's over a $600 kind of increase, close to 10%. And so that's really the power of kind of buying and holding. Whenever there's a big rally like there was in this past month, you won't miss out on any of the upside. Whereas if you were to trade in and out, it would be very difficult to trade and catch this. Of course, not all the time is the market trending as it has in the past month, but buying and holding is the best strategy when it comes to trending environments, and that's largely why Warren Buffett recommends this particular approach, because when the market trends, it ensures that you're fully invested and you're not missing out on anything that might draw you back. Now, when you look at a chart of the S&P 500, the market basically kind of dipped into the November 8th, 9th election, December 1 and 2, and it rallied all the way to Thanksgiving and December, and even in December it rallied even more. And this is the kind of environment that buying and holding is the best strategy, as Warren Buffett says. And yes, even back in October, when people said the market was too high, that things would collapse, still represented a good buying opportunity. I personally bought SPY, IWM, and QQQ, and recommended that to my friends. And I have to add to that list VOO. Now that Vanguard basically does the same thing as SPY. And if you look at it like from a micro perspective, in terms of performance, it's like ever so slightly better than the SPY. But for the most part, they're basically the same. But to summarize once again, the Vanguard options are basically the VOO S&P 500 index, which has 0.05% expense ratio. So I would recommend buying that. Or if you have over $10,000, you could open an account directly with Vanguard.com and make sure you buy their Admiral share class, not their investor share class. The Admiral one, that one gives you the same expense ratio of 0.05%, but it lets you dollar cost average without any trading commissions. The only exception, of course, is if you use the Robinhood app or service. So that's how you buy the S&P 500 index fund for free with Robinhood in less than 10 minutes. And if you dollar cost average your way in, then you'll be following what Warren Buffett is telling you to do, which is to buy the S&P 500 index in pieces over time. I've started doing this already, and if you'd like to kind of follow the Buffett approach, you should get started as well. Of course, I'll provide links and stuff inside the podcast show notes at lifestyletraining101.com. In the next episode, I'm going to talk about the best option strategy for today's market environment. And I'm talking about a trending environment, and kind of different aspects of this particular option strategy that does particularly well when we have multiple green days in a row. I'll talk about the different variations in terms of strike prices and time expirations and what you can do to maximize your profit. This is, of course, assuming that you expect a massive trend rally starting. But if you're able to determine that there's a good chance that's going to happen, then this option strategy is the way to go. I personally did one. It could have been better, but I'll talk about that specific example, and go through the different options that you could choose from when selecting an option. Signing off, this is Silver Surfer at lifestyletraining101.com. Thanks for listening, and see you guys next time.